a modified ONOC. I won't get into all the specifics, but that's a key term to look for in a disability policy. So just as a quick example, I wanted to throw out just some basic premium numbers. This is a male age 45 in good health. You can read $2,800 tax-free benefit. That's a monthly benefit. This has an ONOC extended, which means that your own occupation is going to be considered there, and it comes with a 180-day elimination period. The elimination period is essentially your deductible, as opposed to on your car insurance or on your homeowner's insurance where you have to satisfy a certain amount of dollars before the coverage kicks in. These types of policies make you satisfy a certain number of days where they're not going to pay until those number of days that you're disabled have lapsed. So after 180 days, this policy will kick in, and it'll pay, it costs $1,875 annually or $164 a month. But, if you look down the bottom of the last sentence, if you pay this policy for 10 years before going on claim, you go on claim for less than 13 months and you've broken even, and that includes the elimination period. So, when you look at these numbers, it's what are you getting what you're paying for? And I think that the value you get behind one of these policies is extreme if you end up going on claim. But again, it's one of those things that's similar to car insurance and homeowners insurance. I'm not looking for my house to burn down so I could take advantage of my premiums that I paid. At the same note, you're hoping that you don't have to go on claim, but if you do, you'd be very thankful that you actually have the coverage. I get a lot of questions about this. People hear that Social Security provides disability insurance. They absolutely do, so it's very important to know. But there are some caveats that come along with Social Security disability. First of all, 65% of SSDI, which is the Social Security disability insurance claim applications, were denied in 2009. So if they deny applications, just out of hand. The average monthly benefit is only $1,065 a month. Less than 97% receive. 97% receive less than $2,000. So it's not a very robust benefit by any stretch of the imagination. And then if you factor in workman's comp, less than 5% of disabling accidents and illnesses are work-related. So that means workman's comp won't normally cover most people. And the last thing that's probably one of the most difficult things is the ENEOC provision of Social Security, which means that if you can flip burgers, you can work. It doesn't matter what you were doing before. If you were a scientist or you were a professor or you were a financial planner, it doesn't matter if you're disabled and not able to do that type of work anymore. If you could do any occupation, then you do not qualify for Social Security disability. So I think I mentioned before, disability insurance is probably preferable to critical illness. I really think that DI is probably the thing that everybody should be looking at. If you're not covered at work, you should be looking for a private policy. But I did want to mention critical illness insurance because it's become very popular in the world. It's one of the top sold policies in Europe, in Australia. And, people typically purchase this policy because they're concerned about a major life event. And essentially what it does is it pays a lump sum on the diagnosis of some type of critical illness. And that may be heart attack, stroke, cancer, paralysis, loss of sight, hearing, speech, etc. And what it does is it helps cover deductibles, co-pays, out-of-network costs, home modifications, even a loss of income, and they also may pay multiple times, which is I guess nice from a financial planning standpoint, not so nice from your health standpoint, considering it would involve two major catastrophic illnesses to happen in a relatively short period of time, 20 years or so. Like for instance, having a heart attack and then 10 years later being diagnosed with cancer. These policies typically will pay multiple times, and then they're based on age, health, and benefits. And I think one nice feature of these policies is they like I said, they cover more than one. They cover more than one illness. And in this example here, we're talking about $25,000 in coverage. So if you were to get those two illnesses, it would be a total of $50,000 in a lump sum. And I think that's that's pretty attractive. But normally after two illnesses, they will lapse the policy. So you normally only get 2 bites at the apple. If you want to look at how much this type of coverage typically costs, we're looking at a 45-year-old couple here that's in good health. They have $25,000 in coverage for each spouse. It's 20 years of coverage. We want to get them up to retirement age, which is typical for this type of quote-unquote workers insurance. and it covers over a dozen critical illnesses, you're looking at $79, $75 annually, or $75 a month. But so, like I said, it's an interesting type of policy, and it's one that a number of people across the world are buying. I still default to disability insurance being a better strategy, but at the same time, I think if you for whatever reason you can't get disability insurance or it just doesn't fit in your overall plan, a nice secondary option may be the critical illness policy. Here's a question I get all the time. Well, my health care insurance, doesn't it cover all this? And in most instances, it's going to cover a lot of the major out-of-pocket costs. If you have a heart attack, it's going to cover, the surgeons working on you and the, whatever type of bypass you may need and so forth. But, if you're in a situation where you have an illness where you want to try an experimental treatment or you want an out-of-network treatment, they're typically not covered. Lifestyle changes and modifications are often necessary. If somebody has a stroke or they're in a wheelchair, you need to have a home modification. So having a lump sum to be able to pay for those modifications is attractive to people. Medications and frequent doctor visits can approach the out-of-pocket max. So, you want to have a little bit of cushion there as well. And, transportation to medical facilities. You live in California, you want to go to a facility in Arizona. You want your family to be able to come down and visit you, to pay for airline tickets and things of that nature. So, like I said, it's not a catch-all policy, but for certain individuals, it is a policy that if you're not going to get anything, it's not a bad option to cover those catastrophic type illnesses.